Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So Steve, I don't know, for some reason I can't share my web browser, so I'm not going to worry about it right now, but I'm going to type my URL in here, just make sure everybody sees that. And
yeah, I put in www.learningmarkets.com. I think they should see that in the chat box.
Great. Oh, perfect. Perfect. Yeah. And
hey, John, I have a question for you. So let's say that the attendees out there, they do have a view of the Australian against the U.S. dollar or whatever, the dollar against the Japanese yen, but they're concerned about options pricing. How do you look at options pricing? I know you've traded a lot of options in your career. How do you keep it grounded and not get overwhelmed by the option Greeks and somebody's taking advantage of me? And these are questions that I get all the time. That's why I figured I would bring it up.
Yeah, that's a really good question. So yeah, sometimes new traders can get really hung up on things like, you know, how worried should I be about delta? And, you know, stuff like that. I mean, those are really fair questions, though, because you'll see a lot of, there's all kinds of different opinions on it and how important is theoretical pricing, et cetera. I would suggest that in most cases, if a trader gets familiar with what's the difference between time value and intrinsic value, and how does an expiration work, and how do what are strike prices, they're about 90% of the way there. I mean, you can definitely dig into, you know, how can I understand a little bit better about how gamma is going to affect my trade or whatever it is, or any number of other Greeks that you may read about. But, you know, retail traders, in general, I don't think that retail traders, those kinds of things are as big of a deal because they're dealing with things on a more, they're not fine-tuning their trades at the level that, let's say, a floor trader would, or somebody who's been trading, you know, is trading massive volumes all day long with a lot of real cost efficiency because they're on the floor or whatever it is. And also, I would say, bottom line, all those Greeks and things like that, that's all based on theoretical pricing. The market is what prices options. So theoretical pricing can get us close, but there's an X factor that we throw into those theoretical pricing models that kind of, it's the fudge factor. We use it to kind of make the theoretical price meet whatever the market price is. So I would say that right there, you know, I don't worry too much about it. It's a lot more about, you know, as traders, we're only going to be so accurate anyway. If we start to parse the data into, you know, the individual Greeks, I'm in general not a big fan of that. I think as long as you understand how the mechanics of how an option works, the tactical issues of an option, you know, when it expires, how time value works, why it melts away as you get closer to expiration, things like that, you're going to be okay. So, and I see a quick question. I hope that kind of answered the question because we get that all the time.
That's definitely, John. That's a great answer. Thank you.
Yeah. Yeah. Okay. So, Ron, you're asking a question about do we need margin for selling options? You do. And you can kind of estimate what margin you need. So there are a couple of ways to estimate it, and margin gets affected by all kinds of things like, you know, what your expiration is and what your strike price is relative to the underlying price and stuff like that. But you could make an estimate that if I sell an option that's got a strike price of, let's say, $100, then I could basically times that by, you know, 20%. That's going to be $20. And times that by 100, and that's going to be my margin requirement for that trade. Now, but so I say that's a really rough estimate. You can actually kind of narrow it down a lot more. That'll probably be an overestimate in most cases. But the final word on margin, especially margin for, you know, index options, sometimes will be a little bit different than, let's say, an option on a stock or something like that. And the final word on it is going to be your broker. So, you know, if you feel a little hazy on what's my margin requirement and do I have a big enough account to be able to fund a margin requirement if I wanted to short an option, then maybe I should have a quick conversation with my broker. But I would suggest, you know, most Forex traders I know who have, you know, the average sized Forex account, they have plenty of money to be able to sell options. So they generally have more than enough within their account to be able to meet margin requirements for shorting options. So if it is something that you're interested in and you look like the average trader, you're probably going to be okay. And if you want to put a finer point on it, talk to your broker and have them walk you through it.
Hey, John, did you see Kevin? That's a great answer. Kevin has a two-part question. Do you see that in the chat box?
You know what? I don't see the question.
Okay. Oh, maybe just sent to me. I'm sorry. I will repeat it. Sorry about that.
Okay.
Let me see. Let me find it now. So I'm just going to repeat, Kevin. So if I understand you, I could create a married put or a married call strategy by buying the call or put against the currency future or Forex pair. Is that correct? And then I'll give you the second part in a second.
Okay. Okay, so I'm sorry. So repeat the first part of the question. Is about
so essentially, you know, either whether you're trading futures or you're trading spot Forex, if you buy a call or a put, could you create the married call or married put position in the Forex like you could in an equities position?
Well, you know, I mean, I think in essence you could. I mean, you know, I mean, I'm talking about here. With the like the example that I used on the Australian dollar. I'm sorry, Steve. What was that?
Oh, I'm sorry. We lost each other for a second. No, I didn't say anything.
Oh, okay. So you know, I mean, it works basically the same way. Here's just the added. There's one piece kind of added to this that makes it a little bit complicated, a little bit more complicated, but not by that much. I mean, if you look at, for example, the Australian U.S. dollar here, you know, it's an index option. So there isn't like a stock you could buy underneath it. But if you were to, you know, short the currency pair in the Forex market, and then buy a call to kind of cover that position, then you're basically setting up the same kind of trade.
Right.
And from a risk profile, I mean, you know, it's not that different than just buying a put. You know, I mean, you could construct the trade like I just suggested, or you could just buy a put. That's also going to have a very similar risk profile, and it's probably something that you know, before you take the trade, you're contrasting them and decide, does a married position or the kind of the synthetic married position, does it make sense, or should I just do the single leg put because I'm bearish, or the single leg call if I'm bullish?
John, that's a great segue to his next question is, are there margin considerations or accommodations for the married position between futures, Forex, and options? I think you just start covering that, but if you wouldn't mind us handling it again.
Yeah, so address the margin considerations for a trade like that?
Yeah, the idea that if if you're long a Forex pair and you buy a put or a call, probably you're not going to see cross margining here, so you're going to need to have some additional capital up, correct?
Yeah. So here's how that would work. I mean, let's just use an example here. Let's say that I went long the AUD, the Aussie dollar in the Forex with one mini lot, so 10,000 units of the base currency. And that I'm going to have to cough up some margin to enter that position, and margin varies from dealer to dealer, but it wouldn't be for a mini lot. You know, I'd be looking at a margin of let's say $100. So that would be the minimum amount I would have to post to enter that trade. You know, and the Forex is a little tricky because your entire account is actually your margin, but because you could certainly accumulate losses beyond that $100. But you need that at least to get into that trade. That's assuming you have 100-to-1 leverage in the Forex, which is pretty extreme. And then if you were also long, you know, a call, and that call cost you, you know, $100 or whatever it is, then the $100 is the expense there. You don't have a margin requirement beyond just that $100 that you had to spend if you're long the option, if you bought that call.
Thank you.
Mm-hmm.
Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.